So good afternoon and welcome to the 724th meeting of the Economic Club of New York. I'm Barbara Van Allen, President and CEO of the club. As many of you know, the Economic Club of New York is known as the nation's leading nonpartisan platform for discussions on economic, social, and political issues. We've had more than 1,000 prominent guests appear before the club over the last century and have established a strong tradition of excellence that continues up to today. I want to give a warm welcome to students from NYU Stern School of Business, the Gabelli School of Business at Fordham, and Mercy University, who joined us today virtually, as well as members of our largest ever class of fellows, a select group of very diverse, rising next-gen business thought leaders. We are pleased to say on October 1st on our website, you'll be able to pick up the applications for the 2024 class of fellows. And we always encourage our members to sponsor fellows. Today, I'm honored to welcome back our special guest, Brian Moynihan. Brian is the Chief Executive Officer and Chairman of the Board of Bank of America, where he leads a team of approximately 215,000. Bank of America was named World's Best Bank of Euromoney by Euromoney magazine in 2022, as well as America's Most Just Company by Just Capital. Brian participates in multiple organizations that focus on economic and market trends. These include the World Economic Forum's International Business Council Stakeholder Capitalism Metrics Initiative, the Financial Services Forum, the Bank Policy Institute, the Business Roundtable, the Clearinghouse Association, American Heart Association CEO Roundtable, and the Business Council. He also is a co-chair of the steering committee of the Council for Inclusive Capitalism and chair of the Sustainable Markets Initiative, which was founded by His Majesty King Charles III in his formal role as His Royal Highness the Prince of Wales. Brian serves as chair of the company's Global Diversity and Inclusion Council and is a member of the Museum Council for the Smithsonian's National Museum of African American History and Culture. He's also a member of Brown University Corporation's Board of Fellows, Catalyst Board of Directors, the Council on Competitiveness Board, and the Appeal of Conscience Board of Trustees. He works with public officials, businesses, and civic leaders at the local level through his participation on the Charlotte Executive Leadership Council, the Massachusetts Competitive Partnership, and the Partnership for Rhode Island. The format today will be a conversation. We're honored to have club trustee and co-anchor of CNBC's Squawk Box, Becky Quick, as our moderator. As a reminder, this conversation is on the record, and we do have a fair amount of media on the line as well as in the room. So without further ado, I will be happy to pass it over to you, Becky and Brian. Thank you.
All right. Good afternoon, everybody. And Brian, I want to thank you for being here today. On top of everything that Barbara just told you, Brian at Bank of America has 68 million customers, either consumers or small businesses. And so I think his numbers are probably better than the numbers you're going to be getting from the government in terms of what's happening right now in the economy. This is like red meat for the Economic Club of New York, Brian. So why don't we just jump right into this? Why don't you tell us what you're seeing in the economy right now? Tell us what you're seeing in consumer accounts. How do things stand? How's the economy look?
Sure. Thanks, Becky, and thank you, Barbara, and thank you to the club for letting me join you again. I do want to say one thing. We had a tough week at our company because one of our directors passed away, and it's a fellow named Frank Bramble, who is known to a lot of people in the banking industry for years, and served on our board, and he was a great mentor of our team, me and the rest of the board members. It helped us through the post crisis, and so we'll miss him. And so I just want to make sure that people knew that because it just broke yesterday. But anyway, the entire Bank of America is sad and thoughts and prayers with his family. But in terms of thinking about the economy, let's start with consumers because it's sort of what we do. So we monitor the data pretty carefully, and so what they're doing today is spending about 4.5% more money in the month of September through the 25th than they spent last September. So what's the context of that? The context of that was for all of 22 versus 21, they spent 9.5% more. For year to date, they've spent about 4.8% more, and now they're about 4.5-ish, to give you a sense, just for the month of September. So what you're seeing is they've slowed down. And now to give a further context, that number is very consistent where it was in 16, 17, 18. It was sort of a 2% growth, low inflation economy. There's sort of a natural, people are a little bit more, spend a little bit more, prices go up a little bit, things go on. So we've seen the consumer end up there. And that's the most interesting thing. And it's really changed from the beginning of the year to the end of the year. If you listen to our earnings call, which I'm sure all of you listened to in the first quarter, we'd have talked about that number being more like 9%, and the deceleration is reflecting higher rates, conservatism on part of consumers, are worried about what's happening next, and all the things. So that's where they are today. Importantly, that means the business prospects then reflect that, right? Because at the end of the day, we have a consumer consumption-driven economy. And so when you look to our business side, what you're seeing is leave aside certain segments, and Bill Ruden's here, and commercial real estate, a whole different subject right now that we're all working through. The industry's working through
to that.
And but if you think about it, by and large, commercial customers, the credit quality is very strong. They have an ability to borrow, and they're only using a portion of that, and less portion they've used in the past. So before the pandemic, they'd average about a 40% draw rate on the lines to do stuff, hire people, buy equipment, whatever it was. Then it dropped to like 30% as the pandemic went through. It rose back up, the mid 30s, and now it's fallen by 200 basis points. So these people could borrow the money. So why aren't they buying? A, it's costing more because the base, the spread 250 basis points, whatever it is on top of the base rates increase. And B, they're not having as much opportunity. And so, so when lending conditions tighten and all this, the surveys, the reality is the customers aren't using the credit available to them because the opportunity is not as high. And so when you talk to business leaders, then the other thing they do is manage expenses carefully, trying to preserve margin. And that is managing labor more tightly. And you're seeing, the job openings decline. You're seeing all that go on. They're still growing wages, but at a much slower growth rate. And we can see that in our daily, weekly paychecks. We can actually see that what's happened in the last 3 months is the rate of growth in those paychecks has come down, especially for higher income, $125,000 households. So it's all slowing down, to put it all together, I guess.
Does that mean you think that inflation has gotten under control because it's the wage price spiral that people worry about?
So the Fed's tough fight is they're fighting this unbelievable force, which is the U.S. consumer. So when I'm talking about the spending, that's $4 trillion of activity by our customers a year. So it's not a small sample, $300+ billion a month. The Fed has to slow that down, because if that keeps going, they can't slow the economy down. So the reality is you have strong employment. I mean, we used to think of 4.5% as being full employment. We're sitting, in the mid 3s to upper 3s, and not many people projecting it to go up a lot faster, into the 4s or the low 4s. Very few people get it to 5%. So that's one thing. So people employed and people working. So the Fed's got to fight that. They're winning the fight right now. They're by their own admission, and this isn't because they knew that they came late. They caught up fast, but now they got the equal and opposite problems. They got to be careful they don't go too far, because you can break the spirits and then we'll go off the cliff. So if you're trying to engineer a soft landing, which people have, or something close to that, in balance, when you look in the current data, they've won against the American consumer. The activity has slowed down, and now it's going to have to work through the system. And that's why the rates will have to probably stay up longer. That leads our economists, that data plus all the other data they have access to basically say we won't have a recession, which is different because 6 months ago they thought we'd have a recession in the first part of next year. Originally, 12 months ago, it was in the latter part of this year. They've now said no recession, and they pushed out the trough in the economy to the second, third quarter next year, going about 0.5% annualized in those quarters, with the first rate cuts coming mid next year. Those cuts coming relatively slowly given the nominal rate curve, and really inflation going, basically from where it is today in the mid to high 3s to more of the 2, just over 2, but all the way down to 25. So it's a slow grind out, but they've won the near-term battle.
Okay, I've got 15 different questions that I want to go back to from this. Let's just start with.
Get paid to do is
yeah. No, I just want to break it all down. So, inflation under control for the moment, consumer spending under control for the moment. I saw a story just this week that said consumers are now the 80% lowest rungs of consumers now have less money in their bank accounts, less cash coming in, less cash equivalents than they did before the pandemic. Like we've spent off that 80% is spent off.
Our data doesn't, we can go into that, but our data doesn't show that.
Okay. What does your data show?
So if you take the cohort of customers that existed in 2019 to early 20 and run them out to today and look at them by size of holdings, their checking and deposit accounts, they're actually still up significantly from that, especially in the lower cohorts. The ones that are down are the upper cohorts. And why is that? People have to remember why people have money in a bank is there's transactional cash and there's cash in excess of transaction investment cash. When rates went up, a lot of that moved. So if you look in the upper cohorts, people had 100,000, 150,000, 200,000, they're actually down pre-pandemic. But that's people moving for the yield of money market funds or direct treasury. But the people who have the money going in and out, they're higher by about. One example I'll give you is people had at that time between 5 and 10,000, average 7,000, and now they're sitting on 21,000. The same customers years later.
Okay, so that tells me that the consumer is going to be really strong. If you're right and these other data points are wrong, the consumer still has a lot of excess cash and maybe. That's
what they had. But remember, a lot of people said in early 22, a lot of people are saying they'll be out of their cash by mid 22. Yeah. And then mid 22, they're going to be out of cash by Christmas. It just hasn't happened. That doesn't mean that it is coming down. And if you look at the cash flow of especially the lower median income consumers, you're starting to see them net cash flow out a little bit. And that's the whole thing. California delayed their taxes that came a little later this year. There's just the gas prices are up. So you're seeing that, but it's kind of cuspy, on the edge of it. But, that balance would have been up. And basically it peaked probably in April of last 23. And it's been bouncing around. It accretes, but even mid-month in September versus the 4-week moving average mid-September versus the month before, flattish to down 1%. And so it's moving down. The perception is it moved out. It quite hasn't done that yet. The higher end deposit industry moved quickly, and that's why deposit industry are down 8% year over year. Okay. If you look at the deposit in the industry, they kind of grew to 5% level. They shot up, and they're still above that trend line. And that, as monetary accommodations take it out, that'll happen. But that is more higher end corporate borrowers, wealthy people pulling the money out and finding another alternative, not the transactional cash. That stays pretty constant. All
right, let me throw out another couple other issues that could, mean that inflation's not over. You look at higher energy prices, and that translates into higher gas prices. Housing costs may not have bottomed out. We may see them picking up again, especially with higher mortgage rates, the highest in 23 years. You can look through a lot of different issues and say, okay, maybe we're not done with inflation. What's your answer?
They haven't. They got to be careful to make sure they've won. But so what drives people's, cost, food prices, which oddly enough, actually are a little bit of a tailwind right now because they have settled back down. Yeah. Energy prices were that for most of the year and have gone the other way now. So our September data shows for the first month since last year, people are spending more money on debit and credit cards on gas than they did that month from the year before in August and September. And that's because of the recent run up in prices, but it's positive by 1%. That's about 7% they're spending just on debit and credit cards, which is only 25% of total spending. So it's regressive in who it applies to, but it's less of an overall impact than people think. So rent is real. And so the question is, rents are tipping over in some places, have tipped over in other places, but they've got to stay where they are because there's 130 million households in America, round numbers, 60 have a mortgage, 60 don't, and that's all rent. And so that is the more meaningful question about what's the impact on households where rental prices go. Then the people with the mortgage are locked in 90% are locked in at very low rates. And so they're not having a change in household carry cost, maybe for repairs and stuff. So the question on rent and what you've seen is rent, I think it's on its 18 months under the one of the data sources, sort of declines, but it's not broken yet. It's still relatively expensive and that's got to catch up. And that's the one I think you have to watch.
And the problem is with a lot of these things, these are supply side issues that the Fed can't control. Yeah. And its toolboxes, again, you're using pretty blunt instruments to try and beat that stuff down.
Yeah, remember the Fed has two jobs. Price stability and employment. Employment's very strong and the price stability they're after, but they don't have the ability to permit a housing development. And that's what caused. So when you work on some of these center city groups, whether it's here in New York or whether it's in Charlotte or Boston or you pick the place, workforce housing is, in shortage in a lot of cities. That is not something the rate structure makes it more difficult to do, but that is a question of permitting and pace of getting those projects built. That is not in their control. And that's one of the difficulties. They'd have one thing to push on, and it doesn't affect that. Now, interesting enough, new houses are being sold and people aren't moving, and all that will settle out when people get more used to rates, because the unusual time is now. It was not. It was the last 15 years. The Fed funds rate below 3%, financial crisis through the really recently. That's the unusual time.
Is that gone forever?
I don't know. I mean, our team at one point published, Dennis Browning, Platt and the team, they published a research report that said we're at a 5,000-year trough in rates, and I tried to figure out
5,000.
I tried to figure out how they calculated the first few thousand, but the view was you had this constant rundown, and so you've been at a very low level on a historical thing. So my guess is we're back in for a higher rate structure.
Okay, let's go back to the recession call, because as you mentioned, you guys thought that there was potentially going to be a recession the end of this year. You pushed it out, and now you're saying no recession, or we're going to see a downturn sometime in 2024.
Yes, our strategies are no recession, very slow growth, 0.5% annualized GDP growth, second and third quarter. So it slows down, troughs, and starts coming back out, gets back up to above 1% at the end of next year, i.e. 24, and then finally gets back to 2% at the end of 25. So this is a low thing.
Gradual. So would you call that a soft landing? Or
that's a soft landing by definition, because it's not.
It's not actually.
Now, the interesting thing is what caused them to change that. It was the consumer early on. What happened, if you're in the, in 22 fall, heading into in a rate structure and all that stuff, and they're going to push it in, they have to. It's the only way to correct it. The consumer kept going. What's changed now is the consumer slowed down. So that means you've got to now have more risk that you could push the other way. But it pushed it out because the activity of the consumer stayed so strong. That was the surprise of the system, was the consumer stayed strong. What's happened in the last 3-4 months is the consumer's turning around, and you've got to be just as mindful of that turn, I think.
Do you think the Fed sees the same thing that you see based on
give it to them? So definitely.
Do you think they think of it the same way?
Well, the question for them is, there's a couple things about not being an economist allows you to have an objective view of some of what but the way an economist looks at price, if you had a price of 100 and it went to 115 12 months later, that's a 15% increase. If the next year went from 115 to 118, that's only 3% increase.
Right, but the consumer still feels the 15%.
You feel the first 15, right? And so there's a little bit of this is inflation's sort of a leg measure, but also a measure that is measuring a trajectory as opposed to an absolute. So because the belief is once it's absorbed in the economy, it's absorbed it. And so there's nothing, it's the math and a science to it. But I think, they see this data, and I think that's why our projection is they raise rates one more time in November, and they start cutting next year, but they cut 3 times next year and then 4 times the year after. But if you take 575 and subtract 175, that's a Fed funds rate at the end of 25 at 4%.
Why do they cut rates if you don't think there's a recession? If it's a soft landing,
because otherwise they can, then now they're working the other side is how to maintain. How to not keep taking out accommodation at the level they're taking out. You have a real rate structure. You don't. If it gets too far ahead of you, it will. Really slow things down.
If the Fed was slow to cutting rates and that was their mistake, which I mean historically that's kind of always the mistake. Yeah. They move too late on just about everything. Why wouldn't they make the same mistake coming out? That especially if people are mad at them for not moving earlier.
That's going to be, and they're going to be data dependent and they're going to drive it. But our people believe that it'll be a slow out because the issue that you're going to start, think about the horses getting heady, which is the American consumer. It's still growing at 4.5%, 5% in terms of activity. So you're pulling back and you got to keep the reins tight to get there. So it's a pretty restrictive Fed funds rate in historical thought process at 4%. And in episodes of inflation, the economists will tell you take longer to get out than people think. They don't come out like that. So they're going to make sure they really got it out. The problem though is as you're doing that, you got to be mindful of the turn on the other side. And I think, if when I talked to you, your colleagues, after first quarter earnings, it's just different now. It's slowed down and the activity slowed down and the attitude slowed down. The consumer sentiments come back down, so there's a lot of, and all this just plays in people's minds and it meaning, high rates on, like I said, 7.5% quoted mortgage rate, so Bill Root and I were just like, I mean, yeah, when I first came into business, primary, they come off at 20%. So this isn't like untold. It's just if you're under the age of 40 something, you've never seen a rate structure like this. And by the way, very rarely, even for people probably under 50. And so, and so you think about, you weren't in business, you were in high school, who cares about the rate structure in high school, right? So, so you think about that dynamic, that shock to the system. I think that starts to play through, but these absolute rates are pretty high, but not incredibly high. And yet
it's the rate of change that gets
it's the rate of change. And then people get used to it. And we were used to it. You didn't think about getting a 4% mortgage, when I bought my first house. That wasn't what you were thinking about.
Okay. Let's talk about labor strife and what we've seen, because let's see, it's the Hollywood strikers, it was the rail workers, pilots have been on strike. You've got the UAW now asking for 40% increase and saying no thanks to a 20% that's on the table, and also wanting a shorter work week while all of this happens. I mean, all of that seems like it's got to add up. And I realize labor unions are a very small portion of the overall workforce, but everybody else's wages kind of get set off of what you see in labor unions too. How does that not work into an inflation problem that comes back?
In part, though, some of that's a catch up to what's already happened. And so you had wages going up quickly, and the contracts are now running off and can be renegotiated.
And there wasn't cost of living adjustments.
Whatever it was. And it's a different story, I'm sure, in every one of them. But what you read about is that, so if you look at, people, wage growth for, people in our company was very strong, from 19, 20, 21, 22 into 23 had
20, 21, 22?
Yeah, strong throughout, and so the percentages are up, our cost of teammates with maybe a couple percent more people is, up 15%.
Well, that's because you've raised the minimum wage too.
Well, that's applies to some. It's just it's all through the architecture, and so I think the contractual side is catching up to that side, whether it's government workers, and then even one of the things that pushes towards inflation is the cost of living adjustments in Social Security last year were very high, and then the state methodologies and stuff. So those things are, again, to your point, why there has to be a lot of diligence here, that you don't make the mistake the other way and let go too early or hold too long. But I think those are all, there's 1,000 things out there that could lead to higher inflation, or inflation be more persistent. There's also a lot of things out there that could slow it down and come down faster. And that's the challenge right now.
One of those, I guess, being the potential government shutdown as we get towards a Sunday deadline. And this is not a debt default. It's not on the same scale, but you do kind of watch it, and it's hard to think how they're going to resolve it between now and then. What would that impact each of the economy?
You guys won't have any to talk about if they got it done. So maybe you guys have to find another topic for a week or two. The belief is, so it's several hundred thousand, 700,000, 800,000 people estimate workers that go full load. There's generally a catch up that they get reinstated, but the near term is stress on those people. So what we do as a company is, you don't have to make your payments on your loans and things like that, and we don't have to, no overdrafts, and we have a policy goes in, whether it's a hurricane or whether it's just that insulates, and all the other banks do. And so you'll see the people do, but meanwhile, if they're not getting current cash flow, even if they're not paying the loans, it's a stress in the system. So, but the overall impact depends on how long it all lasts. And, the belief is it's 1/10%, maybe a little higher by our economists. And it goes up this month and it comes back the next month because it's a catch up and all that money goes back in the economy. Because to your point, the authorization to spend at a level of X is done, which is sometimes a little bit the inverse of what we fought in the spring, for example. So therefore, when people get reinstated, they'll get paid and life will go on. It's not that the aggregate budget is agreed to; it's the 12 component parts. That's different than the debt ceiling and the potential for a lot of other catastrophe. They can't pay the debts and they start to lose credit worthiness. We have to watch the rating agencies. You just had another one put the U.S. on watch, and that's not
Moody's, which is the last one that has a story.
And so you got to watch what they are worried about because there's triggers that go on if things get too far. Not the level people are talking about now that you got to be careful of, but it's not good. Any uncertainty is not good for the market, for people's feelings, for confidence. And this is another one. If the government can't result. What we thought was behind us with the debt ceiling as we emerge, and maybe emerge a couple more times if they do continuing resolutions. And so, from a standpoint of stability and strength, and the markets and don't like uncertainty, this would be one to put behind us.
Let's talk about the markets too, because I believe your wealth management divisions have something like $3.6 trillion in assets under management. You've got a really good feel about what's happening in the markets right now. How do investors feel about things? And are we beginning to see a resurgence of the IPO market with the 3 or 4 IPOs we've had the last few weeks?
I hope you're right on the second, because, having gone from Matthew Coder and the team, having gone from $2.5 billion of quarterly revenue to $1 billion, less than that or more than that is no fun. But the team's done a good job and they gain market share. It's just a tough market. So we're seeing some of that. We're seeing there's just a tremendous amount of activity that is sitting there. And whether it's the maturity of the companies to IPO, whether it's potential transactions, if you get stability in the pricing structure or buyouts and things, it's just, they're not going to go without sort of the certainty around them. So yes.
Meaning nobody wants to bring a deal right now.
Very understandable names, very strong companies. That's going to happen. But the idea of a general flow is far away until you get some stability. Meanwhile, on the personal side, there's people holding a lot of cash because this is not exactly a great statement for the American dream here that you can, the best investments to put your money in cash. That's not exactly going to fuel the next round of innovation and development. But right now, you can get 5.5% by letting the money sit there. That's people are doing that, and so there's more cash that would be ready to move if you had more IPO flows. There's not a lot of equity flows driving demand. There was a little bit last week when the market got down because the pricing you saw some flows, but that's sort of week to week. But there's not a sustained money just coming into the system at the level to put the demand side in for I need equity, and then I'll take the IPOs. So you got to have some breakage, breakup of the logjam, and the logjam is about certainty of everything, because the certainty of a revenue stream for those companies going public, the certainty of the financing costs, the buyout, all that's up in arms. If it just settles at any level, that will add some stability. And then, if people say rates have to come down, they really don't. If people can adjust on both the buy and sell side of a deal to that, if the equity commitments plus the financing costs get adjusted in, it just takes a period of adjustment. But if it keeps moving, you can't stop and figure it out.
Meaning, once we know where interest rates stand, once we figure there's no more hikes.
There's a curve that goes, from 4 to 5%, front to back end, or 3 to 5 to 4.5%. People will quickly adapt to that. It's just that's not clear right now. And matter of fact, they're saying for all, our experts are basically saying for all of 23, all of 24, and all of 25, you're not close to that on the front end, especially. Yeah.
Why don't we talk a little bit about commercial real estate and where things stand right now? Because that's another situation where so much is riding on what happens with interest rates. If interest rates come down, people can refinance, do all these deals. If they don't, they're going to be stuck in a lot of positions. Where are the problems? What should we be looking out for? What are you looking out for?
Well, what we're looking out for, as you think about Bank of America, we made a decision to keep our commercial real estate exposure as a percentage of our loan portfolio at a level. So we're like at 6-7% for all commercial real estate in the offices, 25% of that or something like that. So we basically manage that as part of our responsible growth and how we diversify our portfolios, so that we did the credit quality is high. But if you look at it more generally, and there's many experts in the room here that are in this business, you have to sort out what the thing is. So in the office segment, there are some interesting dynamics. In the retail segment, there's some different interesting dynamics. But in the multifamily housing or residential, it's still very strong. And so you have to sort this out. And then you go into office, the difference between the highest quality buildings and newer buildings versus the older buildings and lower quality buildings, meaning you're going to have more work done for tenant to take them over, is stark. And so the whole, this is a problem, is a very sophisticated analysis based on which buildings, which credit, which underlying tenants, when the leases are up, when the financing's up. And so this just takes a long time to go through the system. But that's the mistake, is people think this happens like that. This real estate's a slow thing. The second thing is a mistake is I think people think this is pandemic induced. there's an acceleration of a trend, but the trend to be much more efficient in office usage by companies was going on. And we only got through, hoteling and all the techniques that we all learned. We only got through about 15 or 20% of our real estate before the pandemic. And we said, this can be done in a way we never even thought it could be done. So, and believe me, I'm not alone in this. All the real estate people in all the companies and all the CEOs are saying the same thing. Wait a second, did we just learn something? So it's not as much the 3 days a week, 4 days a week, 5 days a week debate. It's also, even for people 3, 4, 5 days a week, with all the work we did, going from 130 million square feet of real estate at Bank of America in 2010 to 65, 70 in today. We never got above 80% occupancy of the space. So we still had room to go. And then you say, now I've got this equation where you could do it. We're a little unusual because the way we took out costs in the company, and you went from 300,000 people down to 203 at the low point, and now back up to 210, 15. We're probably unusual at that, but the principle isn't different.
How do you do it? Is that like desk sharing, desk hopping? What do you?
I mean, you have people travel all the time, and the change for an office for flexibility. It's just all that system. You have to, especially banking, the office was a badge of something, and you sort of said, let's get rid of that and have amenities that are much more interesting and fun. And we've learned a lot along the way. It's not all perfect how it worked out, but go back in the days when WeWork and all that stuff, and everybody was looking at that. Think about 16, 17, 18, all this idea of how you can hotel and how you can do all that work and how you can be much more efficient and all that stuff. COVID put some difficulties because distancing and everything, so you had all this other stuff. But the reality is that was going on. And then you just have, if you say 5 days a week and you go to 4, depending which way you want to look at it, a 20 or 25% change, that's the trend. And so that will take time to work through the system.
What does that mean for downtowns? I mean, for cities everywhere?
Well, going all the way back to consumer data, it's interesting that what they call return to office spending. So our team looks at the team in the institute looks at this, and they look at dry cleaning, buying lunches in center cities and things like that to say, commuting costs and stuff. It's actually up 5-6%. So it's still filling up. So that's good news for downtown, but it's tough right now. And it's, when you walk around cities in, the retail space and the small merchant space is just, there's a lot of it empty because the basic dynamic is not there. Because again, if you average 4 days a week versus 5, 25% less people moving around. And so, on the holidays on Monday, I came in New York and it was like 25 minutes. I'm like, what's going on? I didn't remember it's the holidays. That's what it feels like on Friday, even though there's no holiday. Right. And so, so I think that dynamic, and so that's tricky. But again, uses will come out of this, this concentric ring theory series of cities and all stuff. You look historically, what happened is people start to move back in. So phenomenon in some cities is people my age are all moving back in the city because they don't want to commute. They don't want to, and they bring vibrancy to the city because they tend to have more money to spend at that stage in life. So we'll see it play out, but it's right now is a big adjustment.
All right, let me just ask, because we're the New York Economic Club of the meeting here, Economic Club of New York. Sorry. Congestion pricing, drop that on top of a downtown that is already suffering from all of this. And I admit I'm a New Jersey commuter, but
they should charge you a lot. Who wants to charge New Jersey a lot to get this?
What does that do to the downtown area that's already suffering and hasn't come back yet?
I think look,
Midtown.
You're trying to improve the environmental quality of air. You're trying to improve people's awareness of the externalities of these costs. You have to think carefully about how you do it. And so I think, it's been done in other cities, and cities adapt to it. I mean, in London, it happens. And
around. Are you in favor of this or not?
I probably, I'm not sure it's the way to get to the problem if you really want to get to it, but that's the question.
To get to the problem of funding for the MTA?
Or that, I think public transportation has to be pushed to a level that's never been pushed in society before. And that's a uniform question. It's becoming trickier because of all the different reasons of use levels and stuff like that. But I believe strongly that the community ought to just take it on and say, if it's going to cost that much, we got to agree. And so I'm talking a different city, not this city, said make it all free. Then you can see whether you can get
the entire transportation
and just spread it out to everybody, and or to a level of income and down, just across. Well, they do some of that, but the idea is then provide good service, and then you can, because people will pay for it if it works. The problem in some cities it doesn't work. The city works, better than most. I mean, believe me, if compared to other cities, this city works very well when you go to other cities.
What are the other cities?
Boston, one of the lines is averaging 3 miles an hour.
What?
One of the transit lines, they just said they're hitting speeds of 3 miles an hour for big stretches. You can walk faster than that. So, they've got to get the mechanics right. So Governor Healy up there is dealing with a different issue than you're dealing with here. And everybody has different. In Charlotte, they have issues of, they built some spikes in the cities, the way it populated. Can they really do it as a more bus service? And you got 1,000 different things, but I don't wheeze on, because those are political decisions made by people about questions. I think the broader philosophical point of housing and transportation to the business community is very serious. And I think we have to understand that's going to take an expenditure, an investment, and a consistent investment. And for that, we ought to get a return for it, i.e. we ought to get happier employees that are more effective in their commuting patterns and all that stuff. It's not clear there's a design to get that done.
Yeah, and just the idea of saying you've got to spend it and then they will come. With what money? We're dealing with deficits and shortfalls all over the place.
It's always a prioritization question, and that's another issue that when you have the stimulus of IRA, infrastructure and chips, you have the drag of fiscal change in government. Government budgets is a drag on me because of just the receipts are flattening out and the growth in receipts. And so that's going to be one of the tug of wars in the economy, which leads to the question, where's the money going to come from? But it's interesting to work with these different cities, because some cities have a growth problem. Some cities have a sort of a need to invest problem, and other cities have a decline problem. And it's very different questions when you're dealing with different issues like that, in terms of population decline, and how do you deal with that versus, in the Charlotte community where we're headquartered, you got thousands and thousands of people coming all the time to schools. We just a bunch of business executives come to the school system. That was just managed growth. And that's just a foreign concept in other communities. So, so the transportation system there can be built on a growth pattern. That's hard to do in other cities.
Yeah, we just had the Prime Minister of Japan here last week, and he talked about the demographics problem they're facing. You're seeing the U.S. population start to grow again. That's one of the other issues that we've had for a while here. Is there's been low growth and therefore tight labor, and one of the reasons labor is coming down a little bit. There's more growth in the population, maybe through immigration. So it's good. Can we just talk about the health of the banking sector overall? What you think it is at this point? Because the springtime was a pretty shocking time for people to kind of watch and see. Here was a mini crisis that was taking place. We had 3 banks that were shut down, and lots of questions that have come since then. And some people will say, hey, everything looked like it was all clear back in 2007, but then in the fall, in 2008, you had a resurgence of this. And people look, it's the fall, it's a scary time for the markets. Do you worry at all about something like that?
I think, just to be clear, the issue in 2007 and 2008 was, there's issues in the banks that were regulated, but the big issues, look at Raj and others. The issue was all these unregulated institutions with no capital requirements and no liquidity requirements that were causing the trouble. And if you sort of track through it, even our company, we were the rescuer of the non-bank system. Us, JP, and Citi, and others. That then flipped over when you got into the housing and stuff like that. But that's different now. So we don't have the same capital rules. And that's why you saw stability among the large banks during all banks, a bunch of sort through. And so there are different business models that failed, but that's a business model failure. Banks fail. I had 4,000 banks have failed in the last 30, 40 years. I mean, these were some big ones. But big banks have failed all the time. The Bank of New England was a big bank. The Republic in Texas was a big bank. The Southeast Bancorp was big. Continental Illinois was a big bank. And one of the, so there's been large banks failed on a relative basis that were bigger than these banks. And so the point is, nominally they're big, but as a percentage, when the Bank of New England went down, or when the Republic of Texas went down, or Southeast Bancorp went down, this is, half people are going, what he's talking about. This is 1990, late 80s, early 90s. And these are top 10 banks. But it is, they put them in a bridge bank, they ran them until they got them straightened out, and then they sold them to bidder. And our company has been a beneficiary. Fleet with Bank of New England, NCB with the Republic, and we benefited by that. But we were there as a situation stabilized. But they ran the institutions, whole institutions, and sold them. The small ones were liquidated quickly. And at 1 year, I think we bought 6 or 7 or 8 small banks in a year and stuff. That system, that's known. But the business models are different. But the stability of the bank system, liquidity, capital was there, and we actually were able to help with the problem, especially the largest banks at the time of stress. And that's wholly different than when you got to 2008 and Lehman and the troubles of Merrill and others that were kind of interesting. I mean, we lent Merrill money to stay afloat in the time between we signed the deal and bought them. They wouldn't have stayed afloat, and we had to lend $10 billion to keep going.
I guess what was kind of scary this time around is that depositors just fled like that. It was a run on the bank, and it was electronic. The banks didn't have to be open. You were gone.
And that goes down to if you think about the banking, where your deposits come from, the real people's money do real things, and they have transactional cash, whether it's a general consumer, a wealthy consumer business that they use to conduct their daily affairs, and then they have cash above that. Mm-hmm. And the issue was, if most of your cash is that cash above it, when it can go for rate, it can go for anything. And so, but if your cash is the transactional cash, so when a bank like Bank of New England failed, the average mid-sized customer had a deposit with them, also had a loan with them. So there was a sort of a synchronicity that's not what was going on in the institutions that had the problems. And so we went in and tried to stabilize the deposit base, and then to give the people time to let that sort out. And that's why we made the deposit in First Republic. But if you think about it more broadly, there's a natural balance that wasn't present. And so you can always move money out of a bank quickly. That could go on every day. I mean, trillions of dollars are moving through our system, and even smaller banks move a lot. So people confusing, did it allow the news to spread faster? Probably, but you could still get the money out. It just might have been lines. And by the way, there were lines at some of those branches and stuff. So, but in the end of the day, the FDIC is there for a purpose. It was put in after the Great Depression to ensure depositors wouldn't feel their money's at risk up to a level. And then at times it's been used on limited transactional accounts, which is different. But that's an industry guarantee. And so we'll fund that deficit. The government is not on the hook for it. It comes out of the industry. It comes out. They get it done, and then we come in and have to. That's a special assessment debate going on. So I think we're a source of strength, even to the strength of stabilizing the industry real time, and then also ultimately we'll put back up the fund. That's a guarantee. That's missing in other parts of the world. That's why that's why the banking system can't get away from the governmental entwinement.
The question that came up this time, though, was: should it be a $250,000 limit? Should it be an endless limit? Should there be to infinity? And if you're paying the assessment on that, how do you feel about it?
I think that, again, it goes to the more precise thing is the transactional cash, because you don't want. On the weekend, I was getting called by governors, can't you stop this from happening? And other people, and you're saying there's not a lot we can do, but if you think about the idea of a small business having to worry at the end of the day how much cash, whether it's $252,000, that the transactional side has to be thought through. When people make a decision to put the money in for a different reason, and there's alternatives for that money. That's a different.
You mean like payroll or something?
No, it's payroll and all the stuff you have to protect. That's transactional cash. Yeah. What you need to think about is when people putting money in the banking system as investment, there's other alternatives you could do it. But you have to think about, at the end of the day, where you get that right. And so, Don's out there. It's not a simple equation. It sounds like. And by the way, in times of stress, you just got to take away the risk of certain types of risk to deal with the real risk. So the real risk in the late 80s and 90s was commercial real estate exposure risk and other types of lending risk. You had to take away the stress and deposit risk to get to that. The risk here was liquidity risk. You had to stabilize that to do it. And I think, that's part of the lessons learned out last spring is wait a second, did we think about what the risk was and how do we stabilize that risk, which is different than in times past.
As a result, there's a proposed new regulation to look at all banks, $100 million and up. And I think for the largest banks, it would be a 10% increase in capital that they expect you to keep around. For the $100 to $250 million in deposits, it's 5%. And you and Jamie Dimon, a few people have come out and taken the unusual step of criticizing your regulator, saying you guys aren't doing this the right way and this isn't smart. What do you think about the rules? Why is it so important that you're speaking out?
So I think you have to separate the theory behind these rules is that they are the finalization of an open to-do item, which was called the finalization of Basel III. And Basel III was a scheme of bank regulation that was agreed to by worldwide regulators. So it has nothing to do with what went on earlier spring, but the timing is such because there was sort of a to-do. And, as you look at them, we have to be more careful with this than we think, because we have lots of tools have been put in place in the U.S. especially that are much different. And in the end of the day, this is a trade negotiation as much as it is a banking regulation question.
Okay.
Which is if you make the banks in our country from 100 billion up less competitive and have a higher cost of capital, therefore have a higher lending cost to customers, the customers that get those loans are going to be less competitive in the worldwide markets. Now, for people who go into the capital markets, the market's going to determine that price. But for a mid-sized company who's in the auto supply chain, this is going to determine. And if companies in another part in Mexico that are mid-sized, let's say they're selling lug bolts. Company selling lug bolts sells them in the worldwide market. If the company is in America and their institution has 20% more capital in their loan, they're going to have to charge more. Companies in France, and has 20% less, they can charge less. The lug bolts are going in the worldwide market. Those are real types of companies. These are not IBM who's going to the capital markets for stuff. So the impact on that is honestly a question of competitiveness in the American economy. And that's why I have to be much more careful of this thing. And so the trade-off is how much more capital do I need to ensure an incremental amount of stability? And what other tools do I have? You have supervision, you have stress testing, you have liquidity stress testing, you have this, and we've been doing that for years. So the losses as a percentage of capital, the large 8 banks, are 15, 20% under the latest stress testing. They've been relatively constant for a long time. They were at 60% under SCAP, I think, or sub 70 or something like that. They dropped precipitously because the amount of capital has gone up and the safety of the institutions have gone up. And so what are you striving for? And so if you think about for the very largest, they're talking about, 15, 20% more RWA with risk-weighted assets, which then for us multiply times 10 is capital. So if you say that moves from 1.63 to 1.95 trillion in RWA, you go from the 163 billion of capital to 195 billion of capital, and you say, that's 300 billion of loans we could make. Or more, depending on the RWA. That's a lot of lending capacity. That's bigger than that's probably, that size loan book would be about the, 7th or 8th largest bank in the country, to give a sense. And by the way, JP would be the same. And by the way, Wells would be the same. So you're taking out lending capacity. And by the way, you're taking out PNC too. This complies all the way down the line. So we got to be very careful here. And so this is about comedy among nations. And we already gold plate, and we already have stress testing. We already have all this stuff. To give you a sense, the largest bank in one of the countries in Europe is about our size. We have 1 3/4 more capital than they do. Their CET1 ratio, the core capital ratio, is 20% higher than ours. Their balance sheet is exactly the same size as ours. They have $1 trillion in loans. We have $1 trillion in loans. We have $1.9 trillion in deposits. They only have $1.4 trillion or something of deposits. They do the exact same businesses. How can you say, and by the way, now we're saying make that worse?
Yeah.
And so that's what we got to be careful about, because what's the value to the American mid-sized companies and the consumers in this is a loss of access to credit or a cost of credit, which, is a safety and soundness. And then they remember that when they fail, it's our money. Yeah. It's coming out of institutions and we paid out a run rate cut. That's one issue is to think about. The second, then get more technical and classic. But the basic is this is supposed to be international leveling. It's not, it's way on level already, and this makes it worse. The second, it takes a lot of capacity out, and whether that's wise ever or even now. The third is you have lots of other tools. You've been working on these institutions for a long time. And then fourth, it walks away from some of the core principles of bank regulation, which is for mid-sized loan portfolios in all our banks, the OCC regulates, in our case, the OCC regulates us, looks at our credit ratings, integrity, looks at all that. And this would say, well, no, if that mid-sized company does a public issuance, you get less RWA because they have a rated piece of debt
than you do by your own ratings. I'm telling you, our ratings are beaten to death more among all the regulators and all this comparison than the public rating agencies are. So you have almost perfect information. You look across all the banks and see how the ratings works. And so it just throws that all on the table and says we're going to just rely on a factor, which makes no sense. So there's pieces that just go against banking regulation. So we'll see it play out. But it's and the fourth thing I'd say is the controversy is like I've never seen among the people in the Fed and stuff. 30 years, and Roger Cohen's out there. He's been doing it a little bit longer than that. Let's just say that, Roger, and John Dugan. And, I've been doing this 35 years or whatever it is now. I've never seen a dissent, as much a debate among this. So this is this rule and any other rule I've ever seen, and John shaking his head and stuff. And that just means there's a lot of work to get done, I think.
Meaning that you think there's a good chance that things could get changed before the final rule.
We're making our points clear. Whether it gets changed or not, it's not always up to us. But I think there's compelling arguments, and there's also people see different sides of the issue. Should mortgage capital requirements go up?
Mm-hmm.
Is that really something at this point, after we did what we did in the mortgage lending, after we restricted down payments, after we've seen it through different types of ups and downs,
sure.
Half the loans, half the mortgage business off the banks, every asset class, half of it's off the core banking system. And so you can push it more outside, then you have less
regulation, less oversight for what's really happening. What you said was pretty complicated. I'm sure most of the people in this room understand that beyond this room, you're going to have a much smaller audience that gets what you're saying on these things. You hear somebody like Elizabeth Warren talking about how greedy fat cats, you're not doing it right. You shouldn't be being charged for overdraft fees. What are you doing with these things? Why wouldn't you have more capital in the bank? It's not just Elizabeth Warren, it's on both sides of the aisle. You hear some of this. Are you concerned about the rise of populism and what that eventually means?
People, last election cycle, not into this one, I'll get asked again, are you worried about the election? I said, elections have been interesting for a company. That one in 1800 was really tough. And it's musical about it, but people shot each other after it. People were brought up in trees. So elections come and go, and institutions like the major banks in our country.
I can ask about the election, though. This is about the rise of populism in the country.
So yeah,
it look a little different.
One time I in a different administration, what seems like a long time ago, I got asked the question, do you know these people? I said, look, we have 66 million consumers. They have my email. They have my phone number. I hear about them far more and different than you do. And so, so we, the institutions, in the industry, run themselves very carefully, listen to their customers and listen to what's going on. And so, look, we change our overdraft policies. We changed them multiple times over the last 15 years, to the point now where we're down to, really people really want the choice. And so we've gone from $5 billion probably 15 years ago to we'll have $120 million today in overdraft fees. To give you a sense, but we got efficiency in the business by digitizing to make up for that. And that's the play we made. Other people made different decisions, but it's a little hard. Our customer scores are the highest they've ever been. That's representative of 3 million customers we survey directly a month.
Yeah.
That's a pretty good sample. It's a lot more than represent an average person in public office, other than president.
Is it less fun to go to Washington these days, or has it always been no fun?
That's where I'm going in about 10 minutes. So It's always fun.
Said with sarcasm. SEC Chair Gary Gensler has warned that AI is a big threat to the financial markets. He says that it's going to be more transformative or just as transformative of what we've seen with the internet, with the Model T. You guys are moving on AI, but maybe a little more cautiously than some other industries, some other players.
So I think, the principles of machine-driven learning and models and stuff, it's been driven through our enterprise. The principles of using it in the consumer setting, that's Erica, which has 18 million users. We'll have 200 million interactions this quarter, which would have been a phone call or email or text or something. So answering straightforward questions. So we believe in this, fully. And we apply. We just announced last week the institutional cash management platform. It's called Cash Pro, which is digital. We've added Erica to that so that the chat and stuff is more interactive and self-solving and stuff. And so there's a lot that can go on there. We think it's a highly beneficial aspect of what we do, but we have learned with models and things they can go awry. So Jimmy DeMar does a great job of our trading business. Believe me, there's a lot of algorithmic trading goes on, but there's a lot of controls around it to make sure it doesn't go. And the idea of just turning it over and saying, I can come into bank work every day and say, do all the right things in Bank of America and let me know when you're done. It's not going to happen for a long period of time because we have all these talented teammates and real customers and real behavior. That being said, the question is where the near-term benefits clearly, and it's a dramatic extension of some of the programming techniques that have been used of the word object programming, things like that, where you can actually pull down and have it do a lot of programming work that people will tell us who are trying to sell the systems is 30 to 50%. We found it's pretty beneficial. So that's a place you apply it. Assisting teammates to make decisions. So call center operators seeing it, but still having the person, but pulling out a lot of this stuff and doing it for them. That we've already doing and has great merit. Having Erica run and develop more feature functionality, having Erica internalized to help in credit offering memorandum. So there's a lot of places we think it's very big, but we have to be careful. And if for credit underwriting, we've done scored model-driven credit underwriting consumer years and years and years. And I tell you, let's be perfectly honest with you. Mentioning Frank earlier on, we bought MBNA. It had the best data science and data analytics and credit underwriting people that were written books about it. $50 billion of credit card charge-offs later, it didn't exactly work when you got into situations that weren't as predictable by a model. And so you have to have some, at least we hope as humans, you have to have some human judgment still. So you have to be careful how to do it. But the basic principles are really kind of interesting because of the pace at which you can learn. And frankly, we're more ready for this than we probably were as industry generally and as a banking industry because the data work we've done and the consolidation systems, the simplification systems. That's the other thing is you have to make sure the data is really right upon which you're exercising decision on, and that's not a small task right there. And then you have to have the right decision executed, and then you have to be able to relate to the client, and then you have to be able to substantiate it after. And that's what Gary or others talk about is wait, if you make a decision and turn a person down because you showed them the wrong pan on Amazon, if you turn down a mortgage loan, that might be a bigger thing. So that's why you have to be careful.
And it's not very often that I get to talk to you for such an extended period of time. It's been fantastic to be able to go through this. I do have one more question before we go because I need a headline.
Okay.
Jamie Dimon.
Your job is to make headlines.
Yeah, so let's start this. Jamie Dimon said earlier this week that the thing he worries most about is geopolitics. What do you worry most about?
Look, Jamie's been a great colleague, and I have to agree with him. If you think about things you can control and things you can't control. So whether it's what's happening in Europe and the war in Ukraine and escalation vertically or horizontally, whether it's sanctions imposed on China or conflict in China, those things, election outcomes in certain countries with a change one way, the other way. Those are major things. And also in the United States to get this task done of fighting inflation back in a box and not have it too influenced by political outcomes. Because remember, part of this inflation was the desire to give people money way in excess of the damage done in the pandemic. And you can get Larry Summers or someone having to do the calculations and they'll stun you by how far, 6 times, 10 times, whatever it was. So that's geopolitical risk too, is can we realize it's time now to consolidate the budget and try to be thoughtful of what we spend money, but do it. So there's geopolitical risk everywhere. That's it. But I think in the end of the day, in the U.S. context, we got to also be careful that, we need businesses to continue to prosper and continue to hire people and continue to spend money on innovation and continue to spend. AI doesn't do any good if we aren't there to pay the bill to build it. That's because and I think that's where we got to be careful. Some the bank regulatory rules or other rules. The spirit, that thing, that's what makes America different. The European economy and the U.S. economy pre-financial crisis were nearly the same size. And you would have been reporting breathlessly that the EU economy is going to be bigger than the U.S. Mm-hmm. It's grown by about 15 or 20%. The U.S. has grown by a lot more, from 12 to 20 odd trillion, from 12 to 15. That's what makes America. We recovered from a mess. We figured out how to get through it. We took off. That's the question. So anything gets in the way of that, from whatever side of the aisle it comes from, that's not a good thing, because in the end of the day, there's jobs are there because the businesses out there do the work.
But I want to thank you very much for your time today.
Thank you.
Thank you.
Well, that was just superb. Many thanks to you both. Great insights, Brian. I'm pleased to report we have many great speakers. You can actually look at it on the back of your program. I'm just going to mention three in particular. Tomorrow morning, we have a breakfast with the author of Elon Musk, the Walter Isaacson book. So that will be exciting. October 19th, I think a number of you already know that Jay Powell will be joining us, the chair of the Fed. And on December 7th, we just confirmed last night Bill Gates for a dinner. So that is the upcoming calendar. I also just want to be sure everyone's aware we've launched the club's first ever podcast titled The Forum, hosted by Becky Quick. And you can tune in on basically all the different streaming platforms. And last, as we always do, I want to recognize those of our members of the Centennial Society joining us today to thank them for providing the financial backbone that makes our programming possible. So thank you to all those joining us virtually, and we'll see you again soon. And for everyone in the room, please enjoy your lunch. Thank you.